You wake up, check the charts, and there it is. A gap so violent, so unnatural, so mathematically impossible in a healthy market that it feels like someone accidentally typed the wrong number. Shanghai silver, $84. COMEX, silver, $48. A $36 divergence in a market that usually fights over pennies. And suddenly, the world doesn't look stable anymore. Suddenly, everyone is whispering the same question. What happened behind the curtain? Because a gap like this doesn't just appear. It erupts, like a pressure valve blowing off after years of silent stress. The drama didn't start today. It started years ago, quietly, when Western silver markets thought they still controlled the global benchmark. When COMEX believed it could suppress the true physical cost with futures, paper contracts, and algorithmic liquidity illusions, they built a system where 500 ounces of paper promised to represent 1 ounce of real metal. A system where price could be dialed up or down with a few keystrokes. But the key flaw of every illusion is simple. It collapses the moment someone demands reality. And reality, physical silver, has found a new center of gravity, Shanghai. It began with a trickle. Arbitrage traders noticed physical silver in China was consistently priced higher. $1 here, $2 there, nothing disruptive, nothing threatening. But then came the geopolitical fractures, the supply chain decoupling, the energy crunch, the industrial shortage warnings, and the record-breaking buying from Chinese refiners and tech manufacturers. Slowly, quietly, China started hoarding more silver than any country had accumulated in decades. Not publicly, not loudly. Behind closed doors, through private channels, off-exchange deals, and strategic stockpiling mandates. And then one morning, the trickle became a flood. Chinese industrial buyers found that suppliers wouldn't sell at COMEX prices anymore. Mines began routing shipments directly to Asia because the premiums were too high to ignore. Refiners started refusing Western contract terms entirely, and Chinese brokers realized something extraordinary. They no longer needed the West to define the price of silver. They could pull the center of gravity eastward simply by paying the true cost. And once that shift began, there was no turning back. That's when the $36 gap burst open like a fault line. One side of the world acknowledging reality, the other side pretending it didn't exist. The moment the divergence appeared, panic spread through Western trading desks. Not the public kind of panic, the silent internal meltdown kind. The kind that triggers emergency calls between banks, shadow meetings between regulators, and frantic attempts to patch a system that's losing credibility by the minute. COMEX liquidity providers saw spreads widen and premiums spike. Bullion banks scrambled to source deliverable bars but found the shelves barren. Vaults that were supposed to be full suddenly looked disturbingly light, and the metal that was still there had already been spoken for months in advance. Meanwhile, in Shanghai, the buying pressure intensified. Chinese investors, who historically favored gold, suddenly pivoted toward silver as if responding to a coordinated signal. Orders surged from retail traders, industrial giants, and state-linked corporations. And every ounce purchased at $84 sent a message to the world. The real price of silver isn't T, where COMEX says it is. It S, where actual buyers are willing to pay. That message shook the Western system. Because if Shanghai can set the real price of silver, what stops it from setting the real price of gold? Copper, lithium, nickel? What happens when the world's largest consumer of raw industrial power decides the West no longer gets to dictate valuation through derivatives? The answer is simple. The pricing power shifts, and once it shifts, it never returns. Behind the scenes, Western officials tried to downplay the divergence. Temporary volatility, they said. Regional imbalances, they claimed. Speculative distortion. But every trader who has been around the block knows those explanations are code. Euphemisms for one thing, loss of control. Markets don't diverge by $36 without a structural failure. Something broke, something deep, something foundational. Rumors spread like wildfire. One theory said China's tech giants had quietly locked in multi-year silver supply for EV production, solar expansion, and battery manufacturing. Another claimed Shanghai banks were instructed to accumulate silver aggressively as part of a national strategy to insulate the country from Western sanctions. Another idea, the most disturbing one, suggested that the West had massively underreported industrial silver shortages, and Shanghai simply revealed the true clearing price for physical metal. But a darker whisper circulated in private circles. What if COMEX silver is essentially insolvent? What if there simply isn't enough physical metal backing the mountain of paper? What if the system kept rolling forward only because no one demanded delivery at scale until now? If that whisper is true, then the $36 gap isn't a market event. It's a warning shot, a global signal that paper promises have finally detached from physical reality. And every major player knows that once those two diverge far enough, one of them must snap. Either COMEX must reprice upward violently, triggering panic, bankruptcies, and forced liquidations, Or Shanghai must somehow fall back down, which would require China to voluntarily undervalue its own assets. And China never does that. So now the world watches a split screen. East pricing silver like it's scarce, essential, irreplaceable. West pricing silver like it's abundant and controlled. Both cannot be true. One side is lying, or at least pretending. And deep down, traders know exactly which side it is. That's why, in private, insiders are no longer arguing about whether the gap will widen. They're arguing about how fast it becomes a global contagion. Because once consumers, investors, and industries worldwide see that silver trades at $84 in the world's biggest industrial hub, they begin to question the legitimacy of the $48 COMEX print. They question the entire pricing architecture, and the moment enough people question it, the system fractures. And that fracture is already visible. The $36 gap is not an error, not manipulation, not a temporary glitch. It's the first crack in a dam that has held back true price discovery for decades. And now the water is pushing through, unstoppable, accelerating, hungry. Because the market has finally realized a truth the West hoped would stay buried. You cannot suppress reality forever. You can only delay it. The moment a $6.8 billion extraction was confirmed, something strange happened inside the U.S. supply system. It was small, silent, and extremely easy to miss if you weren't watching for it. The wholesalers stopped returning calls. Now, not publicly, not officially, but procurement officers from major U.S. manufacturers started reporting a sudden shift. Emails went unanswered. Delivery confirmations were suddenly under review. Internal notes at refining hubs mysteriously changed from processing to pending allocation. This kind of thing just doesn't happen unless the upstream supply chain is under serious pressure. And pressure of this scale usually only happens during a war, a major sanctions crisis, or a catastrophic refinery shutdown. But this time, none of those things happened. All that happened was one hidden buyer removed $6.8 billion of physical silver. That single act was enough to seize the gears of the entire system. And if you want to understand just how fragile things really are, just look at what happened next. A major U.S. solar manufacturer, one of the top 5 in the country, placed a request for an emergency supply that normally ships in about 3 weeks. They were told it could take 3 months. That's not just an inconvenience. For them, that's a full-blown crisis. Because solar isn't optional for these companies. They run on strict timelines, they face penalties for delays, and they have government requirements to meet. But here's the part that should really terrify policymakers. The shortage didn't start at the industrial level. It started at the vault level. Several private U.S. vaulting services, which usually post real-time storage availability for everyone to see, quietly removed their public inventory trackers. Now, why would they hide the numbers? Why cover up the availability? Because it's shrinking fast, and visibility causes panic. And panic is the very last thing the U.S. wants right now. Inside the banks, analysts were scrambling. They started pulling data from the London Bullion Market Association, the LBMA, trying to cross-check where this missing silver went. But even the LBMA reports showed anomalies. Inventory shifts that just didn't match normal commercial flows. Vaults that would normally lose maybe 2 or 3 million ounces in a week suddenly lost 20 million. That's industrial scale extraction. When banks notice that type of move, they don't sit around and debate it. They prepare for systemic stress. And that's exactly what started happening behind closed doors. Banks began quietly limiting the size of outgoing physical orders. A major bullion bank reportedly told one of its private clients, "Large delivery requests require additional review and may be delayed." That single sentence should send a chill down the spine of anyone who understands how commodities are supposed to work. Silver is not supposed to be delayed. Silver is supposed to be available. Silver is supposed to be there. If a bank starts hesitating, it means the bank is no longer confident in its own supply chain. And once the banks show fear, the squeeze only gets worse. Meanwhile, retail investors had no clue anything was happening. Prices barely moved. The charts stayed relatively calm. The headlines were completely silent. And this is exactly why the big players love stealth accumulation. It creates an illusion of stability even as the entire system is being drained from the inside out. The real-world impact hit long before the price impact did. Factories were affected before traders were affected. Procurement officers saw the warning signs long before the financial analysts did. This is how real shortages begin. The $6.8 billion buyer didn't just take silver, they removed the buffer. And the U.S. system is built on buffers. It only functions if people assume the metal is always available. You remove that cushion, and even small disruptions quickly become chaos. Then came the quiet confirmation that something serious was happening. A high-level logistics manager leaked that multiple silver transport companies had been redirected to non-traditional destinations. When pressed for more details, they said the shipments had no commercial identifiers. Translation: The metal isn't going to refiners, it's not going to banks, and it's not going to industrial users. It's going to a private, undisclosed location. Someone is building a massive off-market hoard. Someone who has absolutely no interest in public exposure. Someone who knows exactly how fragile the US supply system really is. And this is where the second shockwave hit. The US Mint, always the first institution to feel this kind of strain, slowed production without giving a reason. They didn't halt operations. They didn't issue a warning. They just quietly reduced their weekly output. That only happens when their suppliers can't guarantee consistent deliveries. And when the Mint slows down, it means the refinery pipeline is compromised. When the refinery pipeline is compromised, it means the wholesalers are struggling. And when the wholesalers are struggling, it means industrial users are next in line. This entire chain reaction is now under stress because of one single silent buyer. And inside Wall Street, traders began whispering the same three-word question: is this coordinated? Because a move this large, executed this cleanly with zero media attention, no price spike, and no institutional fingerprints, doesn't look like a private investor. It doesn't look like a hedge fund. And it definitely doesn't look like a US entity. If anything, it looks like a sovereign strategy. That's why analysts are worried. That's why procurement teams are nervous. And that's why the vault operators suddenly went quiet. Because if the buyer is a sovereign fund, one operating quietly through a network of intermediaries, the US has no tools to stop them. The US cannot intervene. The US cannot sanction unknown private buyers. And the US cannot police global silver flows. The US can only react. And right now it's reacting far too slowly. By the time silver hits the mainstream news, the real crisis will already be locked in. Because the biggest danger isn't that the silver is gone. It's that the market doesn't know how much is left. The uncertainty itself is the weapon. And this hidden buyer just used it flawlessly. Several analysts tried to investigate the move by tracing shipment IDs, but the shipments were split across dozens of different carriers and custodians, making any kind of tracking nearly impossible. This is exactly how governments accumulate strategic metals, quietly, indirectly, and with layers of separation to hide their tracks. If this is a sovereign accumulation, then the US has a national security level problem on its hands. Silver is central to our modern world. It's in military radar, satellites, semiconductors, and even explosive triggers. It's critical for medical technology, solar infrastructure, telecom, AI servers, and EV components. A shortage here could hit the U.S. economy even harder than the chip shortage did, and that chip shortage already cost the U.S. billions. Meanwhile, the hidden buyer just keeps accumulating. Shipment data shows that the $6.8 billion extraction wasn't a one-day strike. It was the first phase of a multi-week operation. If phase 2 is already underway, then what we're looking at are the early stages of the largest silver drain in U.S. history. And yet, the public still has no idea. This is how a collapse begins. Quietly, behind sealed vault doors, with one hidden buyer making moves that only the insiders can see. And by the time the average American realizes there's a problem, silver will already be too scarce, too expensive, and too late. The $36 silver gap didn't close overnight. It didn't even narrow. Instead, it widened slowly, deliberately, like a tear in fabric that had been stretched far too tight for far too long. With every passing day, more people realized the truth. The world wasn't witnessing a price anomaly. It was witnessing a power shift, a change in who controls the heartbeat of global metals, a change in who decides value, a change in who leads and who follows. For decades, the West assumed pricing power was permanent, that COMEX in London were untouchable, that derivatives could override physical reality forever. But the Shanghai surge, that $36 gap, revealed something uncomfortable. Power doesn't fade. It transfers. And it transfers to whoever actually owns the metal. As traders, analysts, and CEOs scrambled to understand what was happening, something far more consequential unfolded beneath the surface, something that would shape the next decade of global economics. Silver stopped being a commodity. It became a battlefield, because once the price gap stabilized, not at $36, but drifting toward 40, then 42, the world split into two camps. Those who fought to defend the old pricing system and those who embraced the new reality. The West clung to the old world. The East built the new one. Western institutions attempted every tactic: margin requirement adjustments, coordinated rate guidance, overnight liquidity injections, strategic selling of paper to push the chart lower. But every push downward on COMEX was met with a harder, more aggressive wave of physical buying in Shanghai. Each new dip in Western paper silver wasn't seen as weakness. It was treated as a clearance sale. Shanghai buying wasn't speculative. It was industrial hunger. And industrial hunger does not care about chart patterns, sentiment, or analyst forecasts. It buys until its needs are met, and China's needs were colossal. That was the moment global investors began to ask a terrifying question. If the West pushes paper down and the East buys every physical ounce at higher prices, what happens when the West finally runs out of silver to suppress the price with? What happens when there's nothing left to sell? No remaining inventory to stabilize markets? No vaults to draw from? Because beneath every market system, beneath the charts, the derivatives, the screen-based liquidity, there is one truth. Someone, somewhere, eventually must deliver real metal. And the real metal was being drained faster than anyone could publicly admit. Large vaults in London saw inventory outflows quietly accelerate. Bars that had sat untouched for years began moving. High net worth clients in Switzerland requested physical delivery rather than paper statements. Major wholesalers in the US reported unprecedented shortages in 1,000-ounce bars, the very bars used for industrial allocation, not retail coin buyers. The trend was unmistakable. The world wasn't buying silver as an investment. The world was buying silver as a lifeline. Meanwhile, the East moved to secure long-term dominance. China expanded refinery capacity. India increased its silver imports to levels not seen in a decade. Japan began quietly accumulating strategic metal reserves. South Korea accelerated its semiconductor silver sourcing. One by one, Asian economies aligned themselves with Shanghai pricing. Not by agreement, not by treaty, not by policy, by necessity. Because if you're an industrial nation that needs silver to build your technological future, you don't wait for a Western paper market to correct. You follow the market that actually has the metal, and that was Shanghai. As the world shifted, a profound psychological reversal occurred. For decades, Western traders mocked premium markets. Now COMEX became the discount market, the market nobody trusted, the market pricing a fantasy, the market whose contracts were beginning to feel less like assets and more like IOUs. Then the event happened. The event that shattered whatever thin illusion of stability remained. A major Western electronics manufacturer, one of the biggest in the world, announced in a closed-door briefing that it could not secure silver at COMEX prices. Even worse, suppliers told them the only guaranteed delivery was from Asia at Shanghai pricing, with 3-month lead times. When this leaked, panic hit global supply chains like a shockwave. If one manufacturer failed to secure metal, how many others were next? This was the moment the world realized the $36 gap wasn't just a financial divergence. It was a signal of a deeper fracture, a structural break in global resource flow. And structural breaks don't reverse, they realign. Suddenly, financial media began asking questions they had ignored for years. Why did COMEX allow 500 paper ounces per 1 physical ounce of backing? Why were inventories falling year after year while production stagnated? Why did industrial forecasts predict massive shortages without a price response? Why had the West pretended silver was abundant when every long-term study said otherwise? The answers weren't comforting. They were devastating. The paper-silver system had never been built to withstand a world where physical buyers called its bluff. It functioned only as long as nobody needed the real metal in size. But the solar boom, the EV revolution, military expansion, and the battery explosion had changed everything. The demand curve wasn't just rising, it was going vertical. And in that kind of world, only one thing matters. Where is the real metal? The answer was now obvious. It was in Asia. It was in Shanghai vaults. It was in Chinese factories. It was flowing into Indian industry. It was being locked into long-term strategic reserves. COMEX had the paper, Shanghai had the metal, and markets always follow the metal. The final blow came quietly. An international mining conference, held discreetly in Singapore, ended with a single, chilling revelation. A consortium of Asian buyers signed multi-year contracts directly with major global mining firms at prices far above COMEX, effectively bypassing Western exchanges entirely. That was the moment insiders knew. The old era was gone. The West had lost pricing power, and the $36 gap wasn't a gap anymore. It was the new gravitational center of silver. By the time the world fully grasped it, the shift had already solidified. The East sets the price. The West reacts. The market is realigned. The gap didn't close. The gap became the market. And silver's true value, long buried, long suppressed, long denied, finally broke free into the open. Thanks for watching. If you found this story compelling, be sure to like and subscribe for more deep dives into the forces reshaping our world. We'll see you in the next video.